The national debt is on pace to hit $50 trillion over the next 10 years.
We did.
Where does it come from? Do you just print it?
We print it digitally. So we as a central bank, we have the ability to create money.
Because they talked about, oh, prices are up. No, prices are down under the Trump administration, and they're down substantially.
Digitally, and we do that by buying treasury bills or bonds or other government guaranteed securities.
Prices are up in the United States for coffee. It's up almost 20%.
That actually increases the money supply. We also print actual currency, and we distribute that through the Federal Reserve banks.
A surge in past due student loans is sparking new concerns about the health of the U.S. economy. Student loan delinquencies.
I really don't understand why it has not done more damage already.
The cost of groceries. We're looking at the cost of daycare. These are the costs that plague the American people, and Donald Trump is up in some escapade.
Venezuela, Russia, Ukraine, and we'll worry about Greenland in about 2 months. Let's talk about Greenland in 20 days. You're losing jobs, and then they say, by the way, we have a correction a month later of, 100,000 jobs are missing.
This disappointing number is a result of all the turmoil over tariffs and the trade wars.
I mean, you talk about 50 trillion. I mean, I remember when we're talking about 10 trillion. Trillion. We're just spending like we're on
Utility, up 11.7%.
How can you possibly sustain this? I hate debt.
And then electricity is up 5.1%.
But a long time ago, it was supposed to have collapsed everything, and it hasn't. It has seemingly had almost no effect, which I don't understand.
And vehicle repair, if you need your car fixed, it's up 11.5%.
We need Greenland from a national security situation. It's so strategic. Right now, Greenland is covered with Russian and Chinese ships all over the place.
Is running straight into a brick wall in terms of its finances. The city of Chicago is facing $1 billion deficit. State's facing a massive deficit while also needing to bail out things like the Chicago Transit Authority.
Bills are all
Schools
high.
is asking for a bailout. The state cannot afford these things.
States received about $800 billion from the federal government to kick off the decade. That
Simply flooded the system with money.
Yes, we did. That's another way to think about it.
2026 is not going to feel like a collapse. It's going to feel like deja vu. Central banks easing again, politicians promising relief again, markets celebrating. After all, this is what happened in 2021, this is what happened in 2001, this is what happened in 2009. And every time they said, this is going to stabilize the system. And every time, households got weaker. So if free money worked, then why do we need to use it again and again and again? Well, this is the political cyclical lie. Every single easing cycle begins with a scandal. 2008, the banks lied about the risk. LIBOR was rigged. Mortgage bonds were, frankly, fake. No one ever goes to jail. Instead, politicians rescued the system that funded their campaigns and their donors. Then they blamed someone else. They blamed greed. They blamed complexity. They blamed unsophisticated investors, unexpected black swan events. Why do political scandals always end with bailouts instead of accountability and better governance? The 2026 liquidity illusion is where we need to look. Cheap money doesn't help workers first. It rescues leverage. In 1998, long-term capital management, LTCM, nearly collapsed the global system. And it was only a few tens of billions back then. I say few, which really should exemplify the pressure that inflation has on debasing our currency. But who stepped in to save the day? It was, of course, the Federal Reserve. Not to save pensions, not to save mum and pop stores, to save counterparties and to eliminate the counterparty risk. Now, in 2020, hedge funds blew up again and the treasury markets were imperiled. Who stepped in? Yep, Daddy Fed. Same story, different decade. Why are hedge funds systemic, but families on their own trying to survive, make a living, are not? The cost of living is always a policy outcome because inflation isn't accidental. After World War II, we know the story. Governments inflated the debt away. After Vietnam, inflation erased deficits. After 2008, the same thing. Food, rent, energy. These aren't supply shocks, they are consequences. Because if inflation is always unexpected, why does it always follow stimulus? Because the Cantillon effect is real. Richard Cantillon didn't invent inequality. He just explained it, he codified it mathematically. Because those closest to the money spigot creation always benefit first. In 2009, banks were recapitalized, asset prices surged, wages stalled for another decade. In 2020, what happened there? The same thing. Tech valuations exploded. They got bailed out again. Housing doubled in price. People's wages went down. People were owning about 20 million houses each person. Savings lost their purchasing power. So the question should really be, why does every single rescue, supposed rescue, widen inequality instead of actually reducing it? The market is more fragile than all of us care to admit. Pensions assume a few things. They assume stable growth, positive real yields, honest interest rates. None of those things actually exist anymore because governments promised benefits that they couldn't actually fund. Instead of the reform, they chose suppression, yield control, YCC, QE, TARP, asset rescue programs, negative real returns, negative real yields, negative real rates. If pensions were ever sustainable, why do they depend permanently on fake interest rates? Ask yourself that. A lot of us remain bamboozled about the system because we don't understand one key tenet, which is the Federal Reserve doesn't actually control inflation. It controls confidence. It must keep bond markets alive, keep banks funded, protect banks from insolvency, keep the government solvent, keep pensions functioning on a paper basis and certainly not a mark-to-market basis. What does that mean? That means forever easing, forever stimulus worlds. This isn't a conspiracy, it's just computerific arithmetic. If the system actually needed constant intervention to survive, is it actually stable? No, because inequality isn't a bug, it's actually an embedded, inherent and necessary feature. Every single cycle, who wins? The asset holders, never the workers. Workers just adjust. Savers lose quietly with their money being debased. This is why homes always feel unreachable. The dream seems unattainable. Families delay having children. The nativity rate goes down. People don't have kids and they delay it. People end up with huge amounts of financial debt in terms of university and car loans. Retirement feels like a figment of the imagination. Not because people are lazy, it's rarely the people's fault. It's because debasement rewards leverage, not labor. Capital is in charge of the system. Ask yourself, why does working harder every single year, every single month, every single paycheck, every single decade seem to actually matter less and less than owning assets and capital? Because hard assets exist for a reason. Gold didn't rise because people loved the metal. Housing didn't rise because people felt in the architectural mood. They rose because the denominator weakened, the currency weakened. Debasement is never new. Rome did it, Britain did it, Japan did it, the US had just perfected it. If governments always debase, and they will always debase, why would you trust them with your future savings or that of your children? That's the simple question. So when free money inevitably returns in 2026, your credit isn't going to get cheaper. Your mortgage rates aren't going to meaningfully fall. Credit card APRs will still remain punitive and damaging. Because easing no longer works through households. It works only through institutions and banks. The system hasn't changed. And when banks receive reserves, they don't pass them down. They front-run the assets. They buy the duration. They buy equities. They buy real estate. They buy anything that inflates first. Credit to households is the secondary consideration. Stocks rally without wage growth, and the bottom is forced to buy later at bigger prices and at bigger valuations. Liquidity does not trickle down. It only jumps. It's going to jump to the normal, usual suspects. It's going to jump from central banks to balance sheets, from balance sheets to assets, from assets to those who already own them. By the time it actually reaches the public, there will be higher prices, higher rents, higher insurance, higher cost of livings, and politicians are going to duly panic because voters feel poorer as the markets even reach higher heights. That's where the populism starts. Stimulus checks, tax credits, sold all as compassion, because handing out cash is what wins elections. You don't run out of inflation with checks. And every single round of relief is going to make us poorer and poorer as the debt burden gets higher and higher. This is why the rates stay higher and assets can still rise. Because when debt gets heavier, markets still celebrate. Why you're told the economy is strong, why your costs explode is a paradox. The system no longer needs you to thrive. It only needs you to absorb ever higher prices. So if credit never truly eases for households, but asset prices always rise, who is the system actually designed to protect? The answer is not me and you. In 2026, you need to understand this unequivocally and clearly. 2026 will bring cheaper money, undoubtedly. It will bring much louder, more vociferous promises. It's going to bring way bigger asset bubbles, and you're still going to feel poorer and poorer. Because stability for the government requires sacrifices from households. We're all part of this. We're all in the same bucket. It's for the national effort. Just be patriotic and accept your debt burden, essentially. How many times does the cycle have to repeat before we stop believing in their promises? This isn't about optimism, it's about survival. Cheap money is coming back, and history always says who pays. It's me, it's you, it's never them.